Welcome to the Stock Market Stories podcast, where I interview successful traders and investors. This is the first episode I've done since 2020, and as I'm sure you're aware, that year created tons of opportunity, so I had to put the podcast on hold for the time being. I'm happy to say that I found the time to dedicate to creating and publishing new episodes of the podcast. I'm really excited about the future of the podcast too. I have a number of super interesting guests that I'm talking to, but I'd also love your help. If you want to hear someone interviewed, please send me a tweet at Stock Podcast. That's just the word stock and the word podcast. In addition, please subscribe to the podcast on Apple Podcasts, Spotify, wherever you listen to your podcasts. It'd really help us out. Today we have Chris DeMuth Jr. of Rangeley Capital returning to the show. Chris is a value investor with a penchant for event-driven opportunities. He also runs one of the best blogs on Seeking Alpha, Sifting the World, where he flags asymmetric and often idiosyncratic ideas. In today's episode, Chris explains why event-driven trading is generating most of his returns right now. He gives us an overview of his three largest positions, all of which are event-driven. The now complete Twitter deal, Renren, ticker RENN, and Amplify, ticker AMPY. Chris goes pretty deep on the now complete Twitter deal, as well as how the current activist regulatory environment is affecting M&A deals. All right, so you want to hop into things?
Sure.
Right, so I just want to start out by asking you, last time we talked, it was like in the peak of coronavirus. I think it was March 2020, and obviously very different set of opportunities back then. Can you just walk through how you're viewing kind of today's market?
Sure. I think that COVID plus ZERP had a really unusual, aberrant period for investments that I think of the everything bubble as a period in which there was no opportunity cost, either for capital or time. Dudes were in their parents' basements, wearing pajamas, trading stock. I think that the advent of zero commission trading apps really exacerbated that. And there was a very temporary, very unusual appetite for science experiment companies that would put out very aspirational, if not fictional, hopes for building into a business in a decade or in some implausibly long period of time. This was especially prominent in new issuances, in SPACs and in IPOs. SPACs get a lot of flack for it, but IPOs were really in tandem, capitalizing never profitable tech. And this appealed to new retail investors. All that's changed. We come out of the worst of COVID. We come out of the worst of artificially low interest rates. And all of a sudden, the whole, hey, wait a decade for the science experiment to turn into a company might have been ludicrous at the time, but it was kind of transparently ludicrous after that. So kind of call it end of Q1 2021, when things really started to change. I kind of started writing about this in February and then kind of publicized our portfolio of short ideas in March. And it really focused on interest rates, on new issuances, and conveniently on ARK, just because they kind of conveniently corralled a lot of these kind of science experiment, never profitable tech companies into one place, but there's other aggregators of these. ARK was kind of the most prominent. There were a few others as well, or you could just short them all individually. But that was kind of when the everything bubble really started to pop. And what are we left with coming into this year and this year? So it's the most concentrated portfolio I've ever had by far. It's the biggest, most exposed portfolio in a sense, but exposed to the things we want to be exposed to. I would say that we are very focused on event-driven situations with pretty hard catalysts. We're always going to be exposed to being right or wrong, but we really weren't looking for kind of exogenous macro exposure this year. Litigation has been a big area for us, where we could really be right or wrong, but had hard catalysts that we could invest in. Really, all of our biggest positions have some sort of litigation element, some sort of corporate event that was going to be determined in part in courts. But most prominently in our biggest position, Renren. Fairly prominently in Twitter, one of our 3 biggest positions and by far the biggest merger arb we've ever done, which was bound for court and got to court and might be back in court next week. We'll see. And also to some serious extent, Amplify, AMPY, third of our 3 biggest positions this year and ever, which is a upstream and midstream oil and gas company. That's the kind of thing that we are comfortable with exposures in, as the kind of never profitable tech collapsed. Energy was the one sector coming into this year that we thought would really be something where we could take a swing at, where the thesis is that we have this infatuation with green energy and the energy transition amongst a lot of large asset allocators. But this is something that's going to have a reality to it decades from now, that alternative or intermittent energy is something people like to talk about, but they use oil and gas, and oil and gas is going to have kind of several decades between where it is unfashionable and where it is unneeded, and that's going to be something where we're going to allocate a lot of our capital to, because we're just investors. We're just looking for marginal cost and marginal benefit, and we're not religious or political about it. And so we don't share the kind of ESG fixation that's driving a lot of capital away from oil and gas in places. I mean, most dramatically in California, we have politicians that 1, decry high prices, 2, attack supply, and 3, subsidize demand, which isn't just a bad idea. It's incoherent, but it's exploitable and creates opportunities.
Yeah, a ton of things like I want to ask you about there. We'll get to Amplify, Renren, Twitter. You have some great things to say about that, which you've blogged about, to no end. But you've really concentrated into event-driven trading. And so my primary question there is, why are the returns in event-driven seem to be so good right now?
Sure. Well, it's good during periods of dislocation. So if you have kind of a follow through for a few years of some kind of theme, that might make kind of momentum traders look good. We do a little better, shine a little better, shine a little brighter when there is not that momentum follow through, or there are not obvious directions, where things are perhaps jittery, volatile. And most merger arb spreads are relatively short term. So, the long end has been, where our short idea was kind of at the 30-year, where our long positions tend to be, what is Twitter now? Could be 4 days. So the return we get between now and Friday, if we in fact get $54.20 on Friday, which our thesis is that we will, whether rates are up or down a few bips between now and then won't affect us too much.
Okay, so sort of the dislocation, liquidation, people trying to reposition is what you think is creating all this opportunity.
Yeah, I would also throw out that amongst equity guys, they might understate how much havoc there is in the markets in 2022, because you also have a lot of shifts in the bond market, which is, of course, so much bigger than the equity market. Less entertainment value, perhaps less for CNBC to discuss, but it's a much bigger and more important market to the world, to the economy, to corporations. There's a lot more debt than there is equity traded. And with all of that, in flux that also creates capital structure opportunities. I would say the big failure this year, or the big deferred opportunity, or the big opportunity for next year, or whenever deal financing stabilizes, is that the deal financing market has collapsed, and it has made it nearly impossible for most takeover speculation pre-ARB situations. Those have been very difficult this year. The bright light within pre-ARB takeover situations has been squeeze outs. Has been quite a few successful publicly traded subsidiaries getting taken out for good premiums. We love those situations. We're typically involved trying to find some kind of fulcrum stake we can take and really be relevant, where, for example, the publicly traded MLPs, public subsidiaries, are almost all getting bought this year. And in part, you can have kind of a cynical view of why. It's very funny to look at the funds that tend to traffic in the non-profitable tech that have public and private kind of VC-like investments, and their public book, will be down 50%. Their private book, they'll mark down 5%. Well, that private book ain't down 5%. That's the public marks are a lot more honest. Public companies with public subsidiaries have a little bit of the same dynamics. They can take it out of their misery, at least the appearance of misery, by taking them private, and they've been doing that this year quite aggressively. So that's kind of one area that we've been very interested in. But deal financing has been difficult, but just the whole movement creates a lot of price dislocation and kind of just weird dynamics where there are opportunities for securities that aren't really bread and butter things to own if you're a fundamental guy or an ARB guy. And so that there have been some orphaned opportunities.
Can you give me an example of what wouldn't be a bread and butter security to own for a guy like you?
Sure. One that I'm very interested in, I'll probably have more to say about this in the months ahead, but Spectrum Brands is one that I have not written about yet, but it's a significant investment of mine, SPB. And the reason is that it is not a corporate transaction like Twitter that has kind of an obvious upside downside probability, kind of typical ARB situation. It's kind of gotten somewhat abandoned by fundamental guys, but it has an asset sale in excess of the size of the company, or the current market cap right now. And it is in court. This extremely aggressive Department of Justice has sued to block it. I think it's quite likely the deal's going to get done, that they're going to be able to, by this coming spring, get this done. And I think it's, takes maybe a hair more work, and it's a little bit of a different situation. And whatever we end up with, the money goes to the company, not to us directly. So we have to hope that they will not deserve a big discount on what they get by malinvestment. But it's a very interesting risk reward. We think it's worth plausibly around what it costs right now without the deal, and far more with it.
Like a special situation.
Yeah.
Thing. So you're seeing a lot more of that too.
A lot more of that.
Going right along with the event-driven thing, you called 2022 the golden age of merger arb, and the spreads are super wide and whatnot, and you kind of touched on why that is. So if you could quickly just give us your thought process.
Sure.
Yeah.
So we were squeezed between two problems for ARBs, which I've kind of touched on both, but just to list them. One, the frozen deal finance market, and two, the woke progressive FTC and DOJ. Joe Biden got elected president kind of as a kind of Democrat from central casting, normal guy, kind of has been flopping around DC for decades, not that scary to capital markets, kind of normal politician. But his party and his administration, all of the pressure comes from his left. And he is not young nor energetic, nor particularly engaged in regulatory policy. So it's essentially been outsourced to people to his left, especially Liz Warren, but others who have been crucial to personnel decisions. And you now have heads of the FTC and DOJ who are kind of jihadis who hate companies, hate M&A, are really fanatical, especially on healthcare and on large tech companies. And they're trying to outdo each other to the left. They're kind of tripping over each other to go well outside of these agencies' mandates, their jurisdiction in terms of law, in terms of what they're supposed to be doing, just to kind of weaponize their review process against political adversaries and against companies they don't like. The M&A process is kind of their hook, but the things they're going after have nothing to do with antitrust, have nothing to do with the mergers. They're going after Amazon for a vacuum cleaner deal. I mean, it's just, you can say out loud their rationale for antitrust cases they bring, but barely. I mean, you can say it out loud. It's hard to do it without smirking. And the judges are just stuffing them one after another. They're losing these cases. So there might be woke antitrust, hipster antitrust regulators, but they're not hipster judges. These judges, Republican and Democrat alike, are mostly, these are not just people with serious jobs, but they're the kind of people who, wanted to become judges and wear black robes and sit in these oak lined courtrooms. And they're mostly, with some exceptions I could think of, pretty dang serious people who follow the law. And when it's not on these regulators' side, they lose, as they have time after time in the last few months. And so it's really going to change the dynamics between the regulators and the companies, because the companies are going to become a lot less scared of them. But meanwhile, I don't want anything to do with these arb spreads unless they're incredibly wide and unless they're already in front of a judge, because a lot of them are going to head there. So they're going to bring tons of suits. I don't think they really care if they lose. They're appealing to people who are radicalized and who have kind of an almost religious fervor against these companies. So they just want to hurt or use the process as the punishment against Amazon, against Microsoft, against Google, against healthcare companies. And they're proud of it. So it's not as if they don't understand what they're doing. They know exactly what they're doing. It's what they want to do. And they want to outdo each other. The fact that there are these two competing antitrust agencies currently competing for the affections of Liz Warren is not a good thing for deal time lines and deal certainty, but that causes you to wait. And the fact that the banks are having a huge amount of trouble with syndicating debt also causes you to wait. One of the reasons why I have this huge position in Twitter is looking at the opportunity cost. Twitter had and has no antitrust issue. Twitter has had and has no financing issue. Richest guy in the world without owning a competitor to Twitter. If he wants to get this deal done, he can get it done. If he doesn't want to get this deal done, he has a very tight contract. And the way I think about it is I would not invest in Twitter, the company. I don't have an investment in Twitter. I have a massive investment in the definitive merger agreement that Elon Musk, clean, sober, and free on his own recognizance, decided to voluntarily sign. I have a huge position in the Delaware Court of Chancellery, in the Chancellor McCormick in particular, and a huge investment in the rule of law. And if I can't bet on those things, I can't do anything else anyways. Yeah. So I might as well make a buck or $54.20 between now and then. Because if he can just kind of smirk and write some bad tweets and blow out of his commitment, what am I going to do the next day? Pick up the next merger agreement and read the clauses and see if I can understand the contract, because if he doesn't have to close this deal, none of that matters anymore.
Right. So, I mean, outside of Twitter, you're kind of arbing the dumb money that hasn't adjusted to this new kind of regulatory activist environment. Would that be accurate?
Yeah, or just certainly being patient. Spectrum Brands, which I quite like, is already in front of a judge. And we have a court, we'll have our day in court. If the government wants to settle with us, there were terms that were offered before they sued to clean sweep. So, I mean, the government here really is just being a kind of dramatic, vindictive bully, going after something that has a full offer to fix the whole thing that they're nominally for, which is exceedingly revealing. Twitter is, of course, already in front of a judge, so it's just worth waiting. And a lot of the marginal cases are cases that these agencies will bring, and so just being patient. And there's a lot of other cool stuff to do while we wait. Right on.
I noticed recently the prediction markets for the Senate and the House. I don't know what the date, sometime in November. They flipped. Do you worry, or are you, have your ears perked up to the potential that environment you just laid out might radically change should the Republicans take both the Senate and the House?
Well, the White House still picks 3 out of 5 FTC commissioners. Right now, they have a kind of radical leftist chairman, 2 acolytes, and only 1 Republican. So it's the farthest to the left. And I'm somebody who had great admiration for a lot of the Democrats involved in the Obama administration and era on antitrust, when it was far more bipartisan and rational and economics based and adherent to their statutory jurisdiction than today. The DOJ will still very much be Joe Biden's DOJ, or to the extent that it is Liz Warren's DOJ. So none of that will change. They will have a harder time getting new laws to make the actual law more progressive and targeting non-price-based theories and targeting tech platforms. But they don't care about their jurisdiction limits anyway. So I think it's not going to make that much of a difference. And a lot of the Republicans getting elected from the more kind of populist wing actually have common cause with the progressives. So this isn't kind of the Chamber of Commerce Republicans winning. This is this kind of weird lower right quadrant that can work pretty well with the lower left quadrant on kind of populist anti-corporate sentiment. And so I don't think the concerns I see on the antitrust side getting better if the Republicans pick up the House, and somewhat less likely the Senate. But the scope for big new legislation to kind of step change things in a worse direction goes away.
Okay. Yeah, I mean, I guess on tech, even all of the Trump Republican guys, they agree with all of the like the AOC type of Democrats. They you might see something significant there.
Yeah.
Right. Let's go over Twitter. I don't think you want to spike the ball just yet. Like, for anyone who doesn't know, just like an hour before we're recording this, Musk told I think he told bankers, was that right, that he's intends to close the Twitter deal on Friday, which is in like 3 days from now. It's a spectacle. It's been a spectacle. But your thesis has remained like really simple, that Elon doesn't have much of a case and Chancellor McCormick is a serious person. So you buy Twitter. So can you just go over really quick kind of like your thought process and how you've, with all the headlines, like I was asking before we started recording, like, oh, how about this? How about this? And you're like, well, the details of the case are very simple, like how you've reacted to all the different head fakes.
The details of the case are very simple. And were it not for Elon Musk zaniness this would have been a tedious but lucrative opportunity. With Elon Musk, it's made it a exciting and lucrative opportunity, with kind of more opportunities along the way. The deal contract was something I thought about a lot at the time. One of the ways I think about contracts is trying to understand the negotiating dynamics that both sides have. And when one or the other side is really pushing, what almost always happens is the other side's lawyers essentially dictate terms. So if you have kind of a multi-bidder situation, then you tend to have the target able to really pick a lot of the qualitative terms, and then you can just compete on price. If you have a desperate company that's otherwise going to file for bankruptcy and you have one bidder, then the buyer gets to dictate the qualitative terms. They say, well, we can always buy you in bankruptcy. Your equity holders are getting wiped out anyways. I'm going to write the contract and you're going to say thank you. And in this case, it was a contract dictated by the target, by Twitter, by their lawyers, with a enthusiastic bidder, Elon Musk. And much has been said about how he did not do due diligence. It was very fast. It was very informal. And he got what he wanted at the time. And the target's lawyers made for a contract that's almost as tight as they could make it. It's the kind of thing that in dozens of clauses, they really picked the language that they would often fight for and maybe get a third of a loaf by the time something was signed, but he just signed it. So we had just the contract we wanted. It required antitrust approval, which was perfunctory in the US. In the UK, it required a UK national security approval. It required shareholder vote, but given that it was priced where it was, that shareholder vote was always going to be nearly unanimous, and it was. Reasonable people disagree on what Twitter's worth. I think the estimates range from, call it, $15 to $30 a share, and we're at the very low end of that range. And there could have been an activist that could have come in were it not for this deal. We don't think there were other strategic bidders. We don't think there were really private equity bidders anytime soon. There are things you could have done, but I think $15 a share is kind of probably where it would have settled out, give or take. And nothing about other social media platforms nor Twitter's performance quarterly since the deal was announced gives you more comfort than we had at the time. But we were not enthusiasts of the company, of the management, of the board. I own more shares than the board does in aggregate once Jack Dorsey left the board. So these guys, it was a weird board. They were neither really investors in Twitter nor really users of Twitter. I think I'm not positive this is the case, but I think I probably have more tweets and more shares than the board does put together after Jack's was off. That's probably true. Almost certainly true if you say, compare me to any one of them. I mean, they just don't use it that much. They don't own that much. So I think they were happy to be put out of their misery, and Elon wanted this. It was classic buyer's remorse, very clear in the discovery process. He was concerned about really three things, maybe four things, or three positive things and one negative thing. Three positive things, or three affirmative things, and then one kind of dog that didn't bark. The war in Ukraine, he very specifically cited that and cited as a reason he wanted to slow foot the deal. The potential for World War III and Vladimir Putin and Ukraine, he was very concerned about. Number two, just generally the weakness in the market. But number three, in particular, the weakness in Tesla. If you look at how Tesla declined, the number of, if you denominate the Twitter deal in Tesla shares, it went up substantially from the time that the deal was announced to the time that he kind of first attempted and then purportedly tried to terminate. And then the dog that didn't bark was nobody else bid. No, there was no other. You might be put into a bit of a frenzy trying to bid, thinking you had to get ahead of somebody, but there was no strategic or private equity interest. So he was kind of on his own. So he probably felt a little dumb. He knew that he overpaid. And he's the kind of winging it, fake it till you make it champion of the universe in terms of kind of just saying stuff and making it true. Even if it's not true at the time, even if it's not compliant with regulations, even if it's not consistent with other things he said, he's a master at it. And his fans seem to affirmatively love it. It's not just that they tolerate it, but the kind of winging it, saying stuff, shooting from the hip. It's kind of like they like every full self-driving promise more than the last one and forgive him infinitely inconsistencies with the law, reality, or prior promises. I think they revel in it. I think it's a little bit like the Trump appeal, which I find to be, it's fun to have a hero who can do this stuff. The more outrageous, the better. Living vicariously through them. It's not that they tolerate because they're behaving this way. It's they love it. They wish they could behave that way, and they're glad that the world has one person or two people that can do that. So it's fun for him and fun for them. But he still has this contract, and the contract has specific performance to require that he do the things he says he will. And he was violating it almost daily. I mean, disparagement, non-disclosure. He was disparaging and I think reveling in it. He got done his SEC investigation, and then he kind of went on Twitter right away just to almost reassure himself and his fans that he was defiant. And I think he was kind of defying this contract the same way. And he has this huge fan base of people who love it. And he got to Delaware and found a chancellor who doesn't, who's kind of almost an inverse caricature or inverse character study of Elon Musk. Somebody who's not a fake it till you make it person, somebody who is a rule of law, serious, sober jurist who's going to care about the facts in the contract and not get distracted by his scale or flamboyance. And I think that was pretty clear in all of the steps leading up to trial, which we, of course, at least so far have not made it to trial, but we had a lot of indications of her views on all this. And more than anything else, it was just normal. She truly was treating this like any other case, and any other case would result in specific performance to close the deal. There were excuses that he made, but they were the thinnest veneers of pretexts. The lawyers were willing to bill him to put him down on paper, but they were really each absurd, and his case was really quite ridiculous. And I think that they knew that. His main lawyer in this, Alex Barrow, is somebody who's very skilled in front of juries. If you ever saw the musical Chicago, he's kind of like the lawyer character in that musical, or in, he's a storyteller. He's very good at anecdotes in front of 9 to 12 people, half of whom have double-digit IQs. One person who has a very high IQ, who's paying attention to the details, isn't looking for a story. She's looking for the law and the facts. And that's a wholly different situation that Musk's lawyers were less well suited for. And so as you kind of came into court, I think they made the good call to settle for the original terms. That saves him a lot. It saves him prejudgment interest, which could have really added up every day starting September 15th. through when we get paid. That saves him the legal bills, which of course he's paying the legal bills on both sides. So a big fight involving Skadden-Arps and Wachtell Lipton and Quinn Emanuel, all of whom have the meters running. He's buying Twitter. So he is going to be paying those bills on both sides. He's losing a lot of credibility, which he might need in court for all of his many other cases, including other cases in Delaware. And he was risking losing some or all of his debt financing or equity financing. I think if you look just today, the equity financing, he's tapped. The debt financing, he's tapped. That's going to be in place to close this week, but that could have all been imperiled if he kind of let this play out. And then the judge could have come back and said, I'm specifically requiring you to perform this deal. And so his commitment might have gone up quite a lot. So I think closing this now at the price he agreed to originally is really the best reasonably likely case for Musk, and it could have ended up quite a bit worse.
Okay, yeah, you gave a great outline, and I loved how you were touching on Musk just being like the quintessential tourist. He enters every industry thinking he's an expert, and then the real experts are like, oh, wow, okay, I guess I know this guy's deal now. He did to my industry. So,
and it's worked so well for him. I mean, he has this. He has, like, I don't want to sound too disparaging. And there's some very good descriptions of this in some of the books that have been written about him. But he'll go, for example, to a team of engineers and say, how long will this take? And they'll say, well, given that, we have a lot of dead ends, there's a lot of problems along the way, it'll take 5 years. And he said, well, if everything went perfectly, there were no mistakes. And they'd say, well, there's not no mistakes. There are mistakes right now. How long would it take? Say, well, we could do it in a year if it went perfectly, but it can't go perfectly. And then Musk will go out and say, oh, we'll do this in a year. Well, they'll try and fail and get it done in 2 years. It'll still be 3 years ahead of schedule and better than any other company could do or leader could entice his guys to do. It'll still be almost superhuman. But it's also not true. And it's also the kind of thing that anybody else would be thrown in jail for. So it's kind of has this P.T. Barnum element, but P.T. Barnum was one of the most successful businessmen of his day, and his fans loved it. So maybe it's a victimless crime, or maybe the people who are brought in by this like it. Maybe that if you pay for full self-driving, you get entertainment value out of it. Or if you're a shareholder, there's something fun about it. It's not literally true, and that being literally true when it's a publicly traded company and you're the chief executive officer is a standard that everybody else seems to be held to, and he is not. But it has, I have a certain admiration and fascination that it exists even one time versus 0 times.
Yeah. So like every time in this case, when Musk is pointed to like some 2-headed elephant or something in his circus, he's given, the market has given you an opportunity to buy more at like a great spread.
Yeah.
I'm just wondering like how, you said this is a massive position of yours.
Yep.
Do you keep adding when the spread widens?
So we own some early on. We added quite a bit when he formally purported to terminate. Spread had gotten quite a bit wider then. One thing about bear markets that's just interesting to me is typically bad news is treated as bad when investors are somewhat distressed or at least pressured and there are liquidity constraints. And so it was interesting to me that I think that the idea that he was going to try to walk was pretty clear, call it in early July, and still the stock went down from kind of the high 30s to the low 30s. My wife, for our personal account, I think in 25 years has you could count the whole, on one hand, the number of times she's bought equity, but we, in addition to having a monster position at work, we got compliance approval to buy it personally at that point, which we did. One of the very, very few times we've done that. So we were kind of all in, call it from mid-July. We were all in just straight equity, but also I've written about a number of the options opportunities. The most leveraged way to bet was the kind of January 2023 5250 calls. And when I say the most leveraged, we're talking about, we now know that it's quite possible that this deal closes in October. That's faster than I was thinking in early July. So in early July, when we're talking when the stock was trading for 32 or so, and we're talking about when the 5250 calls were trading for 40 cents. That I was looking at January just I thought it was likely that things were going to be done by then, but I didn't really know it was going to be, so we could have been more aggressive in hindsight, but that was kind of a 4.25x to the deal price. So just a leveraged way to play it. And then you could go down a bit, so kind of 47 strikes out to June to be very conservative on the time. I thought I was more than 50-50 was going to be done by January, but I was 99% sure it was going to be done by June to kind of take off the timing issue. And the magic to 47 was that also captured a nominal recut. So if I was wrong about 54.20, I thought that I was indifferent to the stock at 47. I'd oppose recuts beneath them. And we were very active. We sent a letter to the board. We're opposing a recut, looking for a fight for the original consideration that we thought we were owed. But once you get to kind of call it 50, it becomes ambiguous. And there's really a structural problem, which is we might have accepted certainty at 50, but how can you get certainty from a guy who already contracted for certainty? A pinky promise, a kind of a double promise. We might have done 50 if you put every penny of it in escrow, and had a maybe $10 CVR for violating the non-disclosure, non-disparagement. Again, you could imagine terms, but it would have been kind of ludicrous. You might as well just get done the original deal. So we had a couple other, but I think there were some interesting options, things to do at the time. But we, kind of, hang on throughout. And then, just as recently as this past week, in terms of continuing drama, it had dropped, I think, almost 20% overnight on national security concerns. So that was kind of the most recent time where we had our most recent opportunity, pretty full at this point. But there was a Bloomberg article that combined overeager reporting with a source that was a real source, but just didn't have a lot of understanding of CFIUS's jurisdiction, the politics, or Elon Musk's incentives, which really didn't align with this being a problem. It would have been outside of CFIUS's jurisdiction. It would have been terrible politics for this administration right before the midterms. And the conspiracy theories of Elon driving it would have been the messiest of ways to get out of the deal, because he's a defense contractor with SpaceX putting military satellites into outer space and has a secret clearance. He would have blown up all of that as collateral damage to blowing up a Twitter deal. So it didn't really make sense that he would have used that as a sneaky way to get out of the deal. It didn't make sense because it's not what CFIUS is for, and it didn't make sense because the politics would have been bad. So we had a pretty strong view on that.
Yeah, the dramatic overreaction though kind of touches on everything you've been talking about with like kind of the activist regulatory state, and then Musk making just quick back of the envelope moves, like, oh, like, thinking it's like a smart calculated poker move to do this, and maybe not thinking through the problems with SpaceX that would create. So
Yeah, I would say the scope of weaponizing CFIUS against domestic political adversaries is far more serious than using the DOJ or the FTC, which they're already using against domestic political adversaries. I mean, this is national security. That's like using an armed drone against Elon Musk. I mean, these are serious people doing real work to protect our country. And they're not the kind of people who would be up for that. It would be impeachable. It would be bad politics. But I think before it gets that far, they would simply not do it because it's not their job. The F in CFIUS stands for foreign. Elon Musk is an American citizen. The contract gives Twitter the right to exclude any of the equity financiers. So the fact that there are some foreigners in that doesn't really matter. They don't have control. They don't have board seats. They don't have observer status. They don't have special access to information or any of the governed by statute circumscriptions on the limits of CFIUS. It's going to be really hard for them to come up with another way to use national security. And they're just not going to want to do it. And it would create a firestorm right before elections. And it's just, I think, not going to happen. And I also think, it was just a kind of a bad source. It was interesting right afterwards when the White House disavowed it. It was interesting to me that they disavowed it by name. That it was somebody who's happy to go on the record by name, whereas the mystery sources in the Treasury Department who said we have concerns weren't willing to go up by name. So that was, but it shows how precarious it is, and also shows what it means to be involved in the situation with a give or take $15 downside versus something where I would, all being equal, prefer to be in, where you like what you own anyways without it. I guess Spectrum Brands is kind of that opportunity for me next, where it's something that if I'm deadly wrong, I might break even, and if I'm right, we could have significant upside. But owning something that I don't mind owning here is very different situation than the Twitter situation.
Yeah. One more note on Twitter is, you shorted Tesla against it, which makes sense. But you also shorted the Truth Social DWAC stock.
I did.
Could you explain what the rationale there?
Sure. We think that Elon Musk is going to own Twitter maybe as soon as this weekend. We think that Elon Musk is going to let Donald Trump back on Twitter. We think that Donald Trump loves Twitter just like Elon does, that Donald Trump said he wasn't going to go back, but he says a lot of things, and that this is going to become the kind of ubiquitous town square, and that this SPAC deal for Truth Social's unlikely to go through. There's any number of problems getting SEC approval. They had discussed the deal, largely agreed on the deal before the S1, which is a filing problem. There was really egregious insider trading around, especially the warrant, but around the securities right before the deal was announced, and some other problems with it. It's not likely to happen. If it fails, if the deal is liquidated, the best thing that could possibly happen for DWAC shareholders is to get the cash and trust, and it'll end up being worth about $10. If they don't get that, it's probably worth about $0. and they'll probably lose everything they put into this. But so they should hope that it liquidates. But they've had to push back the vote and so forth. So we think that that is worth either 0 or 10 and trades above 10. We think that the deal is going to lose a lot of its appeal to Donald Trump if he's allowed back on Twitter. And we think that Tesla, and Tesla is our largest short at this point, is going to be the source of needed capital for paying for Twitter. So, I think that also the higher it went, the more comfortable Musk was in paying for Twitter with Tesla. So kind of shorting it had some rationale that even if we lost, and it's, an order of magnitude smaller than the Twitter position, right? This is much smaller position, but as our shorts tend to be, but it's one that we thought made a lot of sense when we were buying Twitter. And I should say also last year, the ARKK short had Tesla in it. Tesla's been one of the better performing things within that, though. Like they had a lot of their kind of probably worthless little kind of tech kind of science experiment companies really have reverted to making sense or making more sense than originally. But if you look kind of how they've really done, Tesla's been kind of a shining light for them. Like they would have had a real trouble and maybe even kind of existential trouble had Tesla really collapsed at this point, say if it had become valued like any other car company. And so it's really what's propped up ARKK in particular, but the ARK funds generally over the past year. If you just look at them, the ARK's down, call it close to 70% over the last year, but Tesla's down, less than half that. And so it's a huge position for them. Has kind of made things less bad than it would have been otherwise.
Are you still short ARK?
No.
Gotcha.
No.
All right, let's.
And really because the other ones have done what we hoped and expected because of the kind of collapse in the other ones, we kind of shifted our attention just to Tesla directly.
Yeah. Let's talk about Amplify. This is another one of your. This is your third largest position?
I don't think we've specified amongst the top three. It is one of our top three positions.
Cool. Yeah, fill us in on the basics of your thesis on.
And I should say, if depending on how Twitter and Renren go, it will become the biggest by far if those two have a return of capital soon. Thesis: oil and gas had a pipeline disaster, but it was the way to think about it is we've had these problems with the ports and with the supply chains, and ports got backed up. Ships were anchoring where they had not traditionally anchored because they had, kind of fluid movement into ports. And we had actually a couple, but we had ships dragging anchors over our pipeline, which was seen as a liability. I saw that as an asset or not our fault. Nobody asks us to make bulletproof or anchor-proof pipelines. We're the victims here. But nonetheless, the stock traded off pretty precipitously and kind of crashed as a result. And we saw that as a really interesting opportunity. So kind of got what for us was a very big position. Got to know the management well. We like and we trust them. Got to know the board. But, the stock kind of had gone from, I think it was over $5. It kind of crashed to under $3 for a while. We bought our position and it's, more than tripled. We think that it's still trading under 10. I think that's going to be an incredible opportunity for people to buy even today. We think that we can settle with regulators and with plaintiffs across the board and kind of resolve all of our issues that result from the problem with the pipeline. And then we can go after insurance and go after the shippers. It wasn't that big. The journalists, first of all, it's California. So this is like the 50th best state to have an environmental problem like this. But as soon as they saw it wasn't that big, instead of reporting that it wasn't that big, they just changed from barrels to gallons so they could keep putting out big numbers to complain about it. But we actually have a barge on site now repairing the pipeline. It's going to be done quickly. We'll get it back online, and the cash flow from the pipeline is going to allow us to deleverage the balance sheet quickly. It's going to allow hedges to roll off quickly, and we're going to come into next year, and it's just going to be a undersized company. There's really no reason to have a sub $400 million oil and gas upstream and midstream company. So it's going to be a collection. It's going to be a weird hodgepodge of assets that should be a very attractive takeover target and should be a very clean story for somebody to buy in whole or in part. But it's kind of in our laps to resolve the current situation. We think by the time that's done, it's worth, $15 to $20 a share at least.
I think I've heard you say about Amplify that I think it's pretty fairly priced given like the pipeline trouble and
without the pipeline. No, right. I think it's pretty fairly priced if the pipeline disappeared.
Right.
But it's the upside is we think we can get it back online and soon. But that's what we're gambling for. We're just kind of gambling our upside.
Yeah. Okay. Cool. So another kind of asymmetric kind of call option type of play. Awesome. Absolutely. Yeah. No, the upside is really the pipeline comes back online, the hedges roll off, the balance sheet gets deleveraged, and within a broad range, oil and gas hang in there. I would say, if you look at commodities and you look at the natural gas price and you look at Brent, if natural gas is $5.61, if Brent is 93.07, it's a bonanza. I think that if you could take a pretty big haircut to that to break even, but a lot of these oil and gas equities are super cheap compared to where the curve is on the commodities. So yeah, no, we love that one. Cool. For someone that's not, intimately involved in the company and is admittedly a tourist to oil and gas, how would you get a feel for how this pipeline is working out? What would you look for?
Well, the company's pretty current on its SEC filings, and we'll kind of be updating the market fairly regularly. I would say that I'm watching the repair in real time and watching the vessels on the site within minutes of them repairing the pipe. So it depends on how time sensitive somebody's interest level was. If they want it within days, they can follow SEC filings. If they want it within minutes, they can watch the site and look at the salvage and the repair. I mean, there are services. I haven't had much to say on it recently, but I'll talk about Planet Labs more in the future. But Planet Labs, ticker PL, you have satellite imagery. You can follow a lot of the companies one might invest in real time, and one can follow. I mean, one thing about shipping and aircraft. We haven't talked about air sail, but when you talk about planes or ships, you can follow all of them. We were able to pretty quickly track down who had dragged their anchors over our pipeline. But we can see where these ships are, including these ships that are currently on site to fix the pipe.
Awesome. You're long Planet Labs, right? Still,
we are, yeah. No, we have a position in that. That is certainly, air sales by far the biggest exposure I've really ever had in a de-SPACed equity. A lot of these in the category of kind of science experiment companies. This is probably one of the cooler science experiments, but it's certainly an out of favor category. I would say that we were skeptics on 90% of these and probably should have been skeptics on 99% of them. Air sales is really the one value investment that came out of the whole SPAC bonanza years. But Planet Labs is a cool one too. I like the technology. I like the service. I like the satellites. And I think that might work.
Cool. So yeah, let's run through Renren. This has been going on for quite a bit. How long?
Years. The founders basically expropriated part of the value. They had kind of a VC-like arm. These guys were going to be the Facebook of China, and anybody who says they're going to be the this of the that, they never seem to be. Kind of this. They had this kind of aspirations to kind of delusions of greatness, and that never came to be. But they had this kind of VC-like investment that they kind of spun off to friends and family. That, amongst other things, had Sophie in it, the kind of discount broker and app, and became very valuable. And shareholders sued to block it, sued to recover the value that was taken. And that's been years of litigation. And it was going very well. The key moments in the litigation, the crux moment in all of this, was when the judge agreed to attach the assets to the litigation in a way that even if they were able to kind of separate out the original people from the assets, that the litigation would go with the assets. So, I mean, these are Chinese nationals, and I wasn't going to go to Wuhan to kind of perfect my legal rights. And so we were actually able to sort this out in the court in New York. And once they were attached, that was when settlement became pretty clear. We wanted $1 billion. They wanted to pay zero. We ended up at $300 million. And there was drama in the middle of, there's quite a lot of drama in the middle of the case in terms of who is going to get that $300 million, which normally wouldn't be ambiguous. It would be the shareholders. It will be the shareholders. And we will get a distribution in excess of the market cap shortly. And that was our best idea for 2022. It's still playing out, but looks pretty good. And we'll have a little stub equity, although it won't be incredibly valuable. If one of these days the share price trades down precipitously, it will be because it's trading X that check that's coming to shareholders soon. The remainders has some value, but it's single digits, low to mid single digits.
Cool. Yeah, these types of plays are always super interesting, and in the public eye, you're one of the only people that flags some of these. with like a big brand. So it's always nice to see.
Yeah, it's time consuming. We've been very involved in the litigation, and have to, you're dealing with a judge, you're dealing with plaintiffs and defendants and other shareholders, and a certain number of people have to agree on how to handle. And there was kind of a dramatic moment in this, and we had, at this point, already had a pretty big position when it went from the mid-20s and bounced off of, I think, I want to say near 10. One of the other times my family actually, in addition to our professional position, bought a significant amount was when it at least temporarily looked like there was ambiguity on who was going to get the distribution, whether it was us current shareholders or the shareholders that existed at the time of the malfeasance, which would have been completely out of keeping of what a whole shareholder derivative suit is. So that would have been a pretty weird decision, but the market certainly reacted dramatically to that. Seemed pretty dramatic at the time, but it's kind of, the whole thing's been cobbled back together again, and it's in its final stages at this point.
Cool. Well, thanks a lot for filling us in on these 3 positions. Definitely a lot of alpha in them, at least that's the way it looks, and it's playing out that way so far.
So far, so good.
Yeah. But before I take any more of your time, because this was only supposed to be a half hour, and we've gone well over that, I want to ask you about the Substack you recently started publishing. Was it Valtudo?
Sure. That's Portuguese for more or less anything goes, and it's the also the predecessor to MMA. So I do MMA, and it's the kind of earlier kind of no holds barred Brazilian fighting sport, largely focused on jiu-jitsu, which I also do. So I kind of in the middle of the summer started writing about this. This is strictly just for my own consumption and anybody else who's interested. And it's kind of trying to put together different things that I'm working on outside of work: trail running, big mountaineering, jiu-jitsu, and CrossFit, and kind of trying to figure out how these things fit together, because they're at a little bit of cross purposes in terms of training and nutrition and recovery. And they're also cross purposes with being 45 years old and starting a lot of these kind of rolling midlife crises at the same time. So kind of, I have coaches that help me. I probably have more coaches that help any non-professional athlete out there right now on all of these things, and helping me get ready for some big upcoming expeditions. But yeah, other than sleep, I kind of work out for pretty pointed purposes. So Valtudo on Substack, for anybody who's interested, sign up. It'll always be free, worth every penny. But it's just kind of what I'm doing. Really trying to kind of optimize my remaining life expectancy for performance on, I want to be, as good a fighter as I can be. I want to be as good a climber as can be, lifter, runner. And I'm doing these things in kind of this hybrid form where it's hard to be great at any of them, but it's also hard to be great at any of them when you're 45. So I'm kind of writing about the process. It seems a little bit absurd that somebody could read this and have a heavier power lift than I do, or run a faster ultra marathon than I do, or climb higher mountains than I do. But it's me trying to cobble together a life that crosses these different pursuits while I have a family, while I have a job, while I age, and using kind of every means necessary, kind of sort of elaborately, to get coaching, to put together a program, and all the things I'm doing to give myself the best possible shot. So I've had fun writing about this. I've gotten really good. It's a much smaller audience than my stock picks, but I've had fun writing about it and gotten some really good reactions, because I'm enthusiastically new at these things. There are people who are more sophisticated than I am who read this and kind of getting, nudged here and there to try different things. But yeah, it's been fun. So if people are interested in really any of those subjects, fitness generally, and also as a kind of non-serious competitor, amongst other things, I got very interested in testosterone performance enhancement supplements, including things that are not allowed in competition that I'm not doing. So I'm not cheating because I'm not competing, but I'm interested that historically there's been this big tension between longevity or perceived tension between longevity and performance. But now I think there's quite a few things that can be done that are longevity enhancing and performance enhancing. And so I've gotten very interested in that direction. So I write quite a bit about that as well.
You ever see that more plates, more dates guy? That's all he talks about is all the like different steroids and performance enhancing stuff.
I might have come across him on Twitter of all places. It's not somebody I know, but I think I'm vaguely aware of him. Yeah.
Yeah, I mean, he'll do like a 45-minute essay on some random performance enhancing thing that some MMA fighter got caught taking. It's really interesting.
That's usually my original source, is when somebody gets banned from something on CrossFit. I'm like, well, they presumed it had some benefit. Let's see what the side effect profile is. Let's see what the, how it relates to other things. So I think it's I think it's a ripe topic. And a lot of the opposition or concern about it isn't really health related. It's kind of, it's either competition related, not my problem because I'm not competing, or it's, well, what if a teenager didn't know how to dose this? Well, I have a team of doctors I work with on learning about everything I do and really carefully managing, prescriptions and doses and so forth. So there's a lot that I can do when it's me against a mountain that I wouldn't know how to do if I was a teenager, in some competition, especially if you're breaking rules. So you're trying to keep everything secret. But there's a lot you can do that's legal and that is health benefiting, longevity benefiting, and really interesting. So yeah, that's one of my topics on Substack for anybody interested.
Cool. When can we expect you to box another hedge fund guy?
Yeah, I don't know. It's funny. I do jiu-jitsu and Muay Thai and then MMA generally. Have not come across other hedge fund guys there. And my coaches are Brazilian from Rio. And so I don't even have that many Americans, but certainly not other hedge fund guys so far. But I walk to work. So I try to say, halfway between my home and office in Connecticut, I'm ready for anything. But so far has been a purely fun pursuit. Has had no practical use whatsoever.
Awesome. Well, Chris, thank you so much for this. It's been extremely diligent, and I think